Hello and welcome to the Zurich offices in Blackrock, County Dublin. I'm delighted that you could join us for our latest in our podcast series. Today we're going to be talking about investing in 2026 and with particular focus on personal investing. Now is a really good time to be thinking about what's the best thing to do with your money. As Irish people, we've been great savers over the last 10 years and particularly in the last 5 years over the COVID time when people weren't able to spend money and got really into the habit of saving. We hear lots of reports about the wall of money that's sitting on deposit. The last reckoning, it was over 160 billion euros that was sitting on deposit, probably not earning as much interest as it could potentially do. So what we want to do today is we want to talk to some experts about how you can make your money work a little bit harder for you and get into investing. Delighted to be joined by two of my colleagues, Daniel Finucane, who's from the Investment Solutions team at Zurich, and Kristen Foran, National Sales Director at Zurich. So, Daniel, coming to yourself firstly, I want to talk to you about inflation. We're all very much aware of how the rising prices and cost of living is directly impacting, particularly things like when we do our weekly shop. But inflation can have a negative effect on people's money on deposit and in their savings account. Can you just explain that to me?
Yeah, so inflation basically reduces the purchasing power of your savings. And so it essentially reduces the value of your money. And that can be really hard to gauge. When you look at your balance in your bank statement, say every month or every year, the nominal balance doesn't change. There's no red inflation charge written in red letters. And so it can be really hard for people to gauge the actual reduction in purchasing power of their money, but it can be very significant on your savings.
Okay, so let's say I have €1,000 in my bank account and I do nothing with it, but in a couple of years' time, that will still be €1,000. But you're saying the purchasing power is lessened. How does that affect?
Yeah, so for example, in the last 5 years, cumulative inflation has been 20%. And so what €1,000 would have bought you in October of 2020 would cost you €1,200 in today's money. And so that just really demonstrates kind of the purchasing power decrease of that money over time.
Okay, so people are doing a really good job. They're saving lots of money. They're putting it into their bank account. But as I said earlier, that money probably isn't working hard enough. So that's why we talk about investing. So before we get into the nitty-gritty, can you just very briefly explain what is investing?
Yeah, so investing basically is just putting your money into different assets with the expectation that it will grow over time and return a profit over time. Now, investing can be done in many different assets. The most traditional assets are equity, which is basically a share of ownership in public companies. You also have bonds, which is essentially loaning money to governments or to companies and then returning an interest on that. You also have other assets like property, which is investing in real estate. And you have alternative assets as well, such as commodities, which would be investing directly into commodities like gold or oil or grains.
Okay, so you talked about cash being eroded by inflation. Can you give me some examples of how people have benefited from investing in some of those assets?
Yeah, so as I mentioned before, cumulative inflation has been 20% since 2020. But if you look at global equities, they've risen over 100% in that time. And so by investing your money, you really give yourself the opportunity to outpace inflation and grow above it, rather than having your money sit in a bank account and letting it devalue over time. You can actually even take advantage of inflation by investing in things like equities and like commodities, as I said, because when prices rise, that's the price of commodities that are rising. And when prices rise, companies' profits rise. And so equities over time benefit from inflation in the long term.
Okay. And if I'm sitting my money is in a bank account and I want to move into investing, do I jump straight into equities or is there other ways of doing it? What's the concept of diversification?
Yeah, so what we would usually recommend is that you would take more of a portfolio approach. And that means spreading your money across different assets. And so what diversification does is it spreads your risk then across assets. And so you can diversify at the asset level, across regions and across sectors, and you can also diversify across asset classes themselves. And what that essentially means then in your portfolio, when one asset is doing well, another one might be doing poorly and vice versa, and it basically smooths out your returns over time. But the important concept of diversification and what investment theory tells us is that it might reduce your risk, but the proportion in reduction in returns, it isn't proportional. So you can reduce risk and maybe not reduce returns by as much. So you're actually increasing or bettering your return to risk ratio.
Okay. Sounds complicated. If I'm a novice investor or I'm just looking to start, is there a simpler way of doing it?
Yeah, so this idea of diversification is the reason why multi-asset funds are so popular, because they offer a one-stop shop solution for diversification. You have a ready-made portfolio there for you, which is usually managed by investment managers to diversify your risk over time and also return a profit as well.
Okay. Okay, that sounds like a good solution. We'll probably explore that in a little bit more detail a little later. Can you just explain to me one thing, though? You talk about ups and downs, and I suppose technically we would call it volatility. What does volatility mean in layman's terms?
Yeah, so volatility is the most common measure of risk that we usually would use. And what volatility basically says is the amount that you can expect to see the price of your asset change over time. And so for a highly volatile asset, you could expect to see large swings in that asset price. Now that gives you the potential for losses in the short term, but you'd also see a greater expected return in the long term. And the opposite is true then for less volatile assets. You have more smoother, gradual returns, but you have less expected return in the long term.
So over the course of, say, a year, you could probably expect to see movement up and down. Like if we take 2025 as an example, there was a significant amount of movement in the market. Will you just briefly talk about that?
Yeah, so we had a lot of volatility in 2025 due to, of course, what happened in America regarding the tariff implementations. But it's important to know when you're a long-term investor, when we talk about the long term, we mean 20 years, 30 years. And so short-term volatility on an annual basis, particularly when you're in a diversified portfolio, isn't as important. You should be, holding on to your assets through that volatility, and with a more long-term perspective for growth.
Okay, Kristen, I might bring you in because Daniel's talking about investing in types of asset classes. Before you get to that stage as an investor, though, there's a couple of questions you should really ask here. And first one is, will I need access to my money? So that sort of brings in this concept of emergency funds and rainy day. Will you explain that to me firstly?
Yeah, I guess it's this idea of what do you need your money for and how do you need it to work for you. So what we're not saying is throw all your money into investing immediately, because that's not really the answer, is it? It's about saying to yourself, well, when will I need my money? So we all need an emergency fund or rainy day fund, whatever you want to call it. And typically we'd say that should be about 3 to 6 months income. So worst case scenario, your job is gone tomorrow. What are you going to live on for the next few months until you get yourself back on your feet? So that rainy day fund is really important. So again, 3 to 6 months, but depends on the individual. So what we're saying is have that money somewhere accessible. So in your bank account that you can access it tomorrow if you need it. After that, any money you have sitting there, you have to ask yourself, what do I want from this? And usually we do have plans, don't we? So we kind of might have an idea, well, that's my holiday fund for next year, but this might be my fund when I'm looking at retiring in a number of years or something I want to do, like travel the world. So if I have those ideas about what I want to do with my money, it's about deciding how many different amounts do I have and where should they actually go. So the first one always has to be your emergency fund because you need access to money.
Okay, so you have your emergency fund. It makes really good sense. And for some people, they probably think, oh, maybe I don't need it, but it's really good to think that you need to have 3 to 6 months. After that, then, the next consideration, I suppose, is time horizon that you mentioned. For investing, what length of time should you be thinking about for investments?
Yeah, so I suppose again, it depends on your objective, right? I mean, what we would say is you shouldn't really invest anything under 5 years. What we see that happens out there in the world of investing is there are peaks and troughs. So it goes up and down, as Daniel has mentioned here. So depending on what's going on in the world, we have seen huge highs, but we've also seen lows too. So you have to give yourself time to actually make the best investment you can make. So really 5 years is an absolute minimum. Some would say it should be 7 or 8 years to start off with. And again, your objective is really important here, because if you're investing for retirement and you're only in your 30s, you have 30, 40 years to look at. So it's hugely important to look at what it is you want this money to do for you and when you're actually going to need it. And that should really dictate your timeline and how you actually invest. That's a really important fact.
Okay, so rainy day, time horizon. The next big consideration for a lot of people, though, is risk. It's like if we imagine a risk scale, and at Zurich we use a risk scale of 1 to 7, and 1 would be your money on deposit. 7 is putting everything on black in a casino. But there is a tolerance between it. So how does somebody work out their risk tolerance?
Yeah, I guess risk is probably seen as a negative word. People fear the idea of risk, but they shouldn't, because risk can be measured. And what we would say is there's something for everybody here when it comes to investing. So as you say, we have the scale we work to, and the idea is that we find the right risk tolerance for the customer in question. And when we find that, then we try and match you to the right funds to suit your risk tolerance level, so you know what you're doing at all times. Thankfully, we do have those scales, and we have risk profiling tools that we can actually use. So in conjunction with an advisor, which we would advise you to do, you look at these tools and you say, well, how does this suit me and my objectives here? And we find the right match for you, and then the right type of funds to suit you. So the risk you take is measured. It suits you as an individual. It's not a one size all. It's not going into the casino, putting everything on one thing. It's about saying, let's find a solution that works for you as an individual.
Yeah, I think that's really important. And we do have some really good tools on Zurich.ie. And I think you mentioned advice, and I think it's really important to seek advice, because they'll guide you as for their expertise.
I think that's really, really important. I think, particularly at the moment where there's a myriad of information on social media, on the internet, it'd be easy to go down the wormholes we fall down it, looking at different things that are available to invest in. But the reality is that, these are complicated sometimes, and, advice is there. Why wouldn't you take it? As I say, it's very rare that we one size fits all, and it's very rare that even one risk profile might suit you, because, as I say, you have different things that you want to do with your money over different periods of time. So a good advisor can guide you, through this process to work out how this fits for you. But advice is important. I really think it is. And I think, your first step probably is to talk to an advisor and then start your journey, and even defining your objectives to begin with. I mean, most of us are in savings because we are in the habit of savings. As you say, we've become a nation of good savers. But what are we saving for? And it's that planning and that financial planning that probably fits in really well here. But a fantastic thing to do. So we would recommend getting advice.
And I think you make a really good point there about risk tolerance, particularly, like as you say, somebody could be saving for 35 years for their retirement. They can afford to take more risk because of a much longer time horizon, or they could be saving for a mortgage or a house or a car, which is a much shorter time horizon, so perhaps taking less risk. Daniel, I want to bring you in again, talking about, you mentioned diversification, you mentioned multi-asset funds. Zurich are experts in managing multi-asset funds. We manage close to 50 billion euros of customers' money. Our most popular range of funds are multi-asset funds known as the Prisma fund range. Can you explain Prisma to me in very simple terms?
Yeah, so the Prisma fund range, you have Prisma 2, 3, 4 and 5 and Prisma Max. They actually recently just reached 15 billion euro in assets under management, having only launched in 2013, so really impressive performance from the Prisma range. Basically what they do is that they're designed as multi-asset funds to cater for different levels of risk tolerance. And that also then caters for different investment objectives and allows us to attract customers with varying different investment objectives and risk tolerances.
So when Kristen talks about doing risk profiling and risk tolerance, we've got those 5 funds will match profiles that we would find on the risk scale from Zurich.
Exactly.
Yeah, okay. And you mentioned they're diversified. So in what way are they diversified?
Yeah, so they invest across many different asset classes, such as equities and bonds, government bonds and credit, so corporate bonds. Also have investments, or alternative investments like commodities, and also property as well. And depending then on the risk level of the fund, you would have maybe more of a lean towards more of the riskier assets like equities. And if it's a less risky fund, then you might have more of a lean towards bonds or cash.
So when Kristen mentions there, like people can read in the press and see how certain assets are performing, certain stocks are performing. So if I think of the Prisma funds, particularly the equity exposure, you're getting exposure to some of the big global companies, the Metas of this world, the Googles, the Alphabets. That's common, is it?
Yeah, of course. Yeah, the Magnificent Seven, as they're called. You have your Nvidias and your Apples. These would all be included in the equity book of those funds. And we also give, exposure to different markets around the world, not just the US, but also in Europe and Asia Pacific and in Japan as well, and Australia. So there's a very wide diversification across regions and sectors as well.
And getting a little bit more technical, really. So anyone who's doing any research around investing, they'll be they'll be hearing things like passive fund management and active fund management. Zurich are very much active fund managers. Will you explain to me what active fund management is?
Yeah, so if you're an investor in the Prisma range, you benefit from the active management of our in-house investment team. And so what that basically means is that we have our investment team in the office. They're working together every day. The more senior members have been working with each other for over 10 years. And so their discussion is ongoing regarding the market. And they can, at any point in time, adjust the asset allocations within those Prisma funds to take advantage of opportunities or to optimize expected performance given the current market situation. And our investment team as well is an award-winning investment team. They've won a number of awards over the last decade, and that's due to that process that I discussed. Every day the active management of taking in new information and adjusting asset allocations to the current market in a timely fashion as well.
They are an award-winning team, and I think the most recent award was the Fund Management Company of the Year award from Business and Finance, and that was only picked up a couple of weeks ago. Where we're recording this, they're actually the fund management team sit directly above us, which is great, so we can have access to them all the time. Kristen, bring yourself back in. You mentioned a myriad of choices, and look, when you Google investing, you get a myriad of different choices, from get-rich-quick schemes in crypto to directly investing in stocks and shares. When it comes to investing with Zurich, we try to keep things a little bit simpler. We try to make it as easy as possible for customers to invest and understand what they do. Daniel's mentioned the Prisma funds. Can you tell me, what are the advantages of investing or saving with Zurich?
I suppose, it's that idea of looking at diversification, so Daniel's talked about the different types of assets we invest in, but if you think about it, we get our heads turned by a particular company, so Nvidia or Apple or whatever, they're doing really well, and we think, I want to invest in that. The funds Daniel talked about there, they'd have hundreds of these stocks and 300 plus of these, and so you don't have to stop and think about these different things. They're in there already. So that's one of the ways we're trying to make it simple to give you that access to them. We do other things to try and make life simple. Our process for applying for a savings plan, to actually set it up and put it in train, that's very simple. We're trying to do that more online now, so people are involved from the beginning. We then give people access to our website where they can actually go onto the online portal and see the performance of their fund on a daily basis. They can dig deep into the back of these products and these funds to see, what's actually there, to see how their money is performing at any given time. So I suppose we're trying to make it as simple as possible, understanding that there are, I suppose there's lots going on in the background, but trying to keep it at a simple level so people can understand it as much as possible.
Okay, and then from and I hate to use the word tax because I know it's a turn off for people, but from a tax perspective, there's certain types of investing where you have to do annual returns yourself and claim through Ross Online and my account. Yeah. With Zurich, you don't.
You don't, because it's built into it. So basically the tax is taken when you exit the fund or after a particular number of years as laid out by the revenue. I think, look, when it comes to tax, this is the important thing. If you're making money, you're paying tax. So it's not so bad, really, if that's the situation. That's how I think about it. And importantly, the exit rate of tax has come down, so we were paying at 41%, it's come down to 38%. And there's definitely a movement, certainly within our industry, to try to get that down further again, to get it more in line with other taxes. But it is there, but it's done for you. You don't have to go and claim that back every year. You don't have to go and do a process with the revenue. It's done in the fund itself. And it's only on your returns. Bear that in mind. So you have to make good returns to actually pay tax.
Yeah. No, I have to say it's a very simple way.
It is.
I'm as a Zurich employee, I'm sort of prejudiced to accepting Zurich, and I'm invested there as well. And I get my annual statement every year, and it's very easy to understand. The online tools are great. I really do. I dip in and out every couple of weeks to see how funds are doing. So it's really, really positive. You mentioned how easy it is to apply, and we're moving online, and advice from advisors is really important. We try not to have a one size fits all approach. Everything is tailored to the customer. Can you just talk me through that a little bit?
Yeah, well, I guess that's why advisors are there, to work with customers directly. What we try to do is provide different products and say, well, there's a range of them there. There's a range of funds in addition to the Prisma funds as well. But advisors are well placed to be able to say, well, what fits my customers' needs? And then let's make it as simple as possible for my customers going forward. And that's really the journey you go on with the advisor. the process, should be pretty straightforward. When you go to talk to an advisor, they will assess your needs, they'll assess your risk profile, they'll work out what the objective here is, and then they'll find the product for you, and then they'll transact it for you quite simply online. So it's trying to keep it at that level that keeps everyone engaged, but keep it simple so we all understand what we're doing. And I guess our focus as a company is to try stay on this journey of keeping things as simple as possible, using the right language, so making it helpful for people to really understand what they have there. And that's an ongoing journey, as you know yourself, but that's what we're focused on doing in the future.
Yeah, I think we recognise that it's a big step for people to decide to invest for the first time. So you try to make it as easy and as comfortable for people as possible.
You do. It's a huge step for people, particularly if you've never done it before. And, we're not advocating that you abandon your bank accounts altogether and go down this road, but maybe it's taking it in simple steps. It's being able to say to yourself, as Daniel said, what's my money buying for me? What is it doing for me? And if it's not doing enough for me, how do I get more? How do I get past inflation? And that has to be the starting point. Well, what more do I need from this? So it is a journey. Very, very often people start small, maybe with a savings plan, might be a regular savings plan, might be the children's allowance is popular. A lot of people would save the children's allowance on a month-to-month basis. You start something up specifically maybe for something in mind you want to buy in a number of years' time. And then over time, they gradually see what's happening, because you can very quickly then work out, well, what's my bank account doing versus what's my savings plan doing here? And you'll start seeing the benefits of it. And then you start working out, well, what else could I do here? And then you might get into lump sum investing as well. So again, they're all doing the same thing. It's about your confidence level as an investor as you move on in time.
I think once you take those steps, you don't regret it.
I don't think so, because you mentioned there the statement you get every year, and that's really valuable. I know I look at that, and day to day you tend not to look at these things because they're doing so much over time. But the yearly statement's really positive, because you definitely can start saying, well, that's how much went in, and that's how much you grew by. And if I had that in a bank account, that simply wouldn't be happening. So as a check-in point on a yearly basis, you do stop and think, this is what I want to see happening here, And you do see fluctuations, and you'll see it going up and down. And, if you're that way inclined, you can go on the website and see it all the time. I mean, like yourself, I probably check in every few weeks to see what's happening. But it's interesting, because even when you do see something going down, a few weeks later, you might see it going back up again. So it's good to keep an eye on it. It's good to track it. But ultimately, you want to see it going in one direction over time, and that's just up.
Yeah, absolutely. Now, as Daniel mentioned, there is volatility. But one of the great things about Zurich, and I know, Daniel, every week you write the weekly investment news that we send out to financial advisors, and we post it online for everyone who's got an online account with ourselves. They get to see it on that. So we try to keep people as fully informed as possible with regard to market movements. Last question to yourself, Daniel. When is the right time to invest? Because you'll always have the people at the back of the mind thinking, oh no, I'll wait until something happens. But that's not the right strategy, really.
Yeah, and there's, a bit of a rhetoric around the market at the moment that prices are very high and maybe overvalued. And, what I would say is that if you're waiting for a time when markets aren't uncertain, you're going to be waiting a long time, The number one predictor of success in investing is time. The more time you give your portfolio to grow, the better chance it has of doing so. So the best time to invest is early. Invest early.
Yeah, I think, and particularly when it comes to pension saving, the sooner you take out a pension, the younger you take it out, the better you are when it comes to retirement. And that's a whole other topic, I have to say.
Yeah, well, I mean, it's this idea of compounding, isn't it? Which is pretty straightforward. You put money in, it grows, there's more money there to grow further as time goes on. So the magic really is in time. The longer money is there for and it's invested for, the more chance you're giving it to grow. It's like if you start a pension early, even at a small level, it will grow substantially. Whereas you started very late, it's going to have a shorter window of time to get there. So time is hugely, hugely important when it comes to investing. So the best time is now. It's immediately. It's a case of not listening to the noise, because there's always noise. You'll always find noise. If you go online and you start searching the internet, you'll get a huge amount of opinion about when to start. It's now.
I agree. Thanks, Daniel. Thanks, Kristen, for that. That was really insightful. Hope you found that useful. I think a couple of key takeaways from that for me would be, one, make sure you have an emergency fund of 3 to 6 months salary that's kept in your bank account. Two, consider investing with the rates, but make sure you've got the time to invest. So you're looking at between 7 and 10 years before you need the money. Work out your risk tolerance. So make sure that you're comfortable with the level of risk you're taking. Choose Zurich because we've got a great range of multi-asset funds which are fully diversified, just like Daniel asked. But most importantly, seek advice. Speak to a financial broker, speak directly to Zurich for ourselves. We'll be able to guide you through. And then the whole process of signing up is very, very simple. We'd love to have you as customers. So take that first step. Thank you very much for joining us. Goodbye.